One of the great growth companies over the last decade is Axon. The company started originally as Taser International, changed its name in the last few years to Axon because the Axon brand of body cameras has really become what the company is known for. It's its growth driver, it's what is allowing really high profitability for the business. But one number sticks out to me at Axon, and that is the fact that the company has grown at a compound annual growth rate, or CAGR, of 27% over the last decade. So I'm going to get to exactly the numbers, what drove that growth, and what sacrifices the company had to make, because this has not all been roses. Revenue growth has been phenomenal, but the bottom line has been lagging. So I'm going to cover all that today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. Let's start with the 27% CAGR chart. This is Axon's revenue. You can see that in 2012, the company had $114.8 million in revenue. That is up more than 10x in the last 12 months to $1.47 billion. Just phenomenal growth rate. And I wanted to break down a few of these into the products that actually make up this growth. One is Axon's software and sensors. This is what the company is known for. You can see that the CAGR here is 60%. So even better growth in this segment. That's partially because it started at a lower base, $5.7 million in revenue in 2012. Now getting close to $900 million in the most recent 12 months. Tasers are what Axon would have been known for if you were familiar with this company 10 years ago. $109.1 million in revenue from tasers. Tasers are not only a growth business, but also generate margins in the 60 to 70% range. The kind of margins that you would typically think of for a software business or a SaaS business. So now up to $588 million as of the last 12 months. These are the real two growth drivers. And from a revenue perspective, if you're looking at Axon, these are the two products that you want to think about. Tasers, relatively simple. It's just a taser product, and then they sell cartridges. The software and sensors business is a little bit more complicated because there's, of course, a number of different cameras, body cameras, cameras that can be worn on glasses. There's a fleet camera that goes in officers' vehicles, and then there are software products that go on top of that. A lot of these products are sold together as a bundle and then through recurring revenue. So a law enforcement agency actually just pays a monthly fee, and then the contracts for those products are up to 10 years. This is what's been a massive change over the last few years, is that Axon is starting to sign these really, really long-term contracts that locks customers into using these SaaS services. And then hardware gets upgraded every so often. Every couple of years, you get a new taser, a new body camera. So it's just a win-win for both Axon and the customer, but this is what has driven the company's financial growth. Before I get to some of the trade-offs, thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So like I said, the growth numbers are phenomenal for Axon, but one of the criticisms could be that the company has not been particularly profitable for most of the last decade. This is a look at revenue and net income since 2013, and you can see here that the company is positive on a net income basis, now $146.1 million in net income over the past 12 months. But Axon was losing money as recently as 2021 and was not particularly profitable in the years before that. You can see that the net margin was actually declining between 2013 and 2021. And what is the reason for that? Well, it's pretty straightforward. Axon was investing a lot in R&D and sales, general, and administrative, or SG&A expenses. The one that really sticks out to me is the R&D spending. You can see that that spending was $9.9 million in 2013. If you think about it, if your main business is selling tasers, there's not a lot of development that needs to go into that. There's no software. A lot of your cost is actually in manufacturing and holding inventory. And then there's obviously the sales expenses that go into selling those products, getting them into customers' hands. But once you move into being a technology company where you're hosting a lot of video in the cloud, you're analyzing that video, you're using artificial intelligence, there's a lot of research and development that needs to happen on that software side. And so that's where you see the explosion in R&D expenses, a CAGR of 41%. So R&D expenses are actually growing faster than revenue over the last 10 years. But the payoff is you get this tremendous business in software and sensors. The SG&A expenses are also very high because this is at the end of the day also a sales business. Not only do they have to develop these products, but you have to get them into customers' hands. You have to sign that long-term contract. You have to test with officers in the field. There's a lot of work that goes into actually getting this product out there and getting it out there at scale. So that's something that Axon has spent a lot of money on over the last 10 years, developing those products and then getting them into customers' hands. But now that you have this flywheel effect going where customers know you by name, you have that long-term contract, I think this is just going to be a more and more profitable business in the future. So Axon is a phenomenal growth company, but is it a stock to buy today or is it simply too expensive? And that's a tough question for investors. I'm going to give you a few stats right here. Enterprise value to sales is now 11.3. Enterprise value to EBITDA, which is a proxy for cash flow, is 94. Enterprise value to free cash flow is 69. And the price to earnings ratio, remember, this is a company that's now starting to be solidly profitable, but that price to earnings ratio is nearly 60. So this is a very expensive stock. If we use a metric like price to earnings growth ratio, which is the price to earnings ratio divided by the company's growth, that's over 2. That's a very high multiple to pay for any kind of growth stock. So that's my one caution with Axon right now. This is a stock that I have owned for a very long time, but I am starting to pare back on that because of the multiple that you're paying. Now, phenomenal company, but a phenomenal company doesn't necessarily mean it's a phenomenal buy as a stock, as an investment. And that's my one caution with this company is that a lot of that future growth is already priced in. Investors are expecting not only revenue growth, but also margin expansion as Axon turns the corner to being a more profitable company. If nothing else, there's a lot to learn about how Axon built this business, started with tasers, moved into body cameras, and then was able to layer on a SaaS product or a software product. All three of those are extremely high margin. They also now have long-term contracts. If you can find companies that have those kind of growth metrics and that kind of growth potential, that's where you're going to get the kind of stocks that 10x over time, like Axon has done. But for the next 10 years, I don't think there's going to be quite as much growth in Axon, even if this is a phenomenal company for the foreseeable future. But what do you think about Axon and its 27% growth rate over the last decade? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.